What's up guys? Welcome back to another video on trading options. Now today's video, I wasn't even sure if I should make it. The reason why is because we're going to talk about the least successful and most speculative form of trading options, which is short-term out-of-the-money debit spreads. And definitely this video is not an intro video. Check out my playlist on trading options. There are now 31 videos for you to watch, and I'm making a series now on vertical spreads. So these two videos talking about credit and debit spreads gives a more broader explanation, and then my previous options video, credit spread examples, I did credit spread examples on Tesla and JP Morgan. Those were credit spreads. In this video, we're going to do two examples of debit spreads. Now, I've been told by my subscribers that some finance YouTubers are charging like $500, $1,000, $1,500 for their options trading course. I'm doing this for free for you guys. Check out this playlist. All I ask is you give my videos thumbs up, sometimes leave me comments, and share my videos with other people you think are interested in learning how to trade options. Now, before getting to the specific examples, let's just do a quick refresher of the four kinds of vertical spreads. In the previous video, we did a bear call spread on Tesla and a bull put spread on JP Morgan. In this video, we're doing the two kinds of debit spreads, which is the bull call spread and the bear put spread. Now, these spreads have an equivalent. If you're going long, you're buying a long call, you're bullish. If you're buying along puts, you're bearish. And if you have the capital in your account for 100 shares, you can sell a covered call or sell a cash secured put. So the spread equivalents are the bear call, the bull put, the bull call, and the bear put. Now, as I said, the bull call spread and the bear put spread, out of the money, short term, is the most speculative, least successful form of options trading, but people for some reason still do it. And we're going to talk about in the money bull call spreads and in the money bear put spreads in a later video. If it's already in the money, it's a little bit different, but we're going to focus in this video on out of the money spreads. And the reason why you would do this is because it is affordable speculation. You need the share price of the company to move really fast, really soon, in order for your spread to make money. However, you're not purchasing the full contract for buying a call or buying a put. By selling a put or a call at a higher or lower strike price, you're minimizing how much it's costing you to purchase the original call or put. So once again, let's just go through the charts. So for a bull call spread, we're going to buy a call just out of the money and hope that the share price moves. Now, this call contract could potentially be expensive, so we're going to negate some of the cost by selling a call at a higher strike price. And we do this to minimize costs. Now, what is our max profit? It's the width of this spread minus the net debit. So you're going to receive a payment for the call you sell at the higher strike price, and you're going to be paying a debit for the call that you're buying at the money or just out of the money. So the max profit you can make is this. What is the max that you can lose? And you can just lose the net debit for the two contracts if they expire both worthless, out of the money by expiration. The reason why these spreads are so unsuccessful is that if the share price just stays flat or goes sideways or doesn't get above your break-even cost, you have to remember that this net debit, there's a line above where you bought the call that is your break-even price. So the share price can't go down, can't go sideways, and can't just get to your break-even price. It has to go higher. And it's the same thing, but in reverse for the bear put spread. Once again, you're going to be buying a put just out of the money relative to the current share price of the stock, and it can be an expensive contract to buy, so you're going to sell a put with a further strike price to reduce your cost. And of course, your max profit is the spread width minus the net debit. The most you can lose is the debit you pay for the two contracts should they both expire worthless out of the money by expiration. And time is not on your side, theta decay is not your friend, and in general, markets tend to go up over time. So the bear put spread is really hard for me to justify for maybe like a 2-week contract. But we're going to do it, guys. We're going to do some live examples in my Schwab account. If you watched my last video, this is the credit spread I sold on JP Morgan. This is the credit spread I sold on Tesla. I also sold one on AMD and Netflix that I didn't do a video for. I'm just starting to accumulate them whenever I see a chart and I say, this looks like a good bet, basically. But we're doing debit spreads, and the first stock that we're going to do a debit spread on is Nike. So this is the 6-month chart for Nike, and I actually really like how well consolidated the 4 moving averages were. And once the moving average, once the share price got below the 200-day moving average, and there was an earnings report, Nike shot up, and it's in a breakout. So where is this stock going realistically? I think it's going to at least hit a nice round number of 175, 180, or even 200 before it starts channeling sideways again. So I think a bull call spread on Nike would be a good option strategy in the next 2 weeks. Now, there's really no reason to reference the Greeks because I'm always just going to buy a contract that's closest out of the money. Let's choose our expiration date, and I am going to go with August 20th because that is the 3rd Friday of the month, and it's in 18 days. The current share price of Nike is 168, so the first call that I'm going to be buying is a strike of 170. I now need to determine a width, and this is up to you. You can play around with the numbers to see what your debit amount will be versus what you could potentially gain. Ideally, 2-to-1 or 3-to-1 is good. So let's go with a strike of 175, and we'll build this chain and see what it tells us. So once again, for a debit spread, you're buying whatever's closest to the strike, closest to the share price. So 168, 170, I'm buying to open this one, and I'm selling to open this one. Let's go ahead and click on trade and see what the final results are. So it's giving us a debit amount of 160. So I'm going to have to pay $160 for this debit spread today. Now, the width of the strikes is $500. So the max profit I can make is 500 minus 160, or about $340. So I'm risking 160 to potentially make a max of 340 by expiration. Once again, I just hate the probabilities on debit spreads, so I am not going to increase the quantities here. If you were crazy about this trade, you definitely could, but I'm going to stick to just one because that's all I'm comfortable losing for you guys on these incredibly risky plays. So I'm going to go ahead and execute this, and we'll see what it looks like in my account. There it is in my account. I have now a bull call spread for August 20th on Nike, and I'm risking, I said, something like 130, 160 bucks or something like that. Will Nike be able to get above 170, which is the first hurdle, but I need it to get above my break even. So 160 plus 170 would be 170, 160. So I need Nike in the next 2 weeks to get above 170, 160 for me to start making money on this spread. Will it happen? I hope so. Sure, why not? I just want to say real quick that if you think Nike's share price is going up, yeah, you can sell or you can buy a debit spread, or you could sell a credit spread. By selling a credit spread and saying, I think Nike's going up, you're still receiving a payment, but if Nike trades sideways, you still win. So in my opinion, if you think a stock is going up, I would rather just bet on it by doing a credit spread instead. So that was the bull call spread. Let's now do the opposite, which is a bear put spread. And let's go ahead and pick on Starbucks and say Starbucks last week was overbought. It got up to 125. However, it's pulling back. And the line of support you've been seeing here is its 100-day moving average or 50-day moving average. And right now, it got way above its 20. And it's been having 5 consecutive red days. But I easily could see Starbucks share price pulling back to the 50 or the 100 again over the next 2 weeks. So let's trade in the short term and do a bear put spread on Starbucks. So once again, here's the option chain, and I'm going with August 20th, which is in 18 days. And let's increase the amount of strikes, and I'm going to choose the strike that's closest out of the money. So Starbucks is currently 120.44. For buying my first put, it's going to be a strike price of 120. And then let's go ahead and choose a width and be arbitrary, and we'll say 115. So the width is $500. Let's go ahead and build this. And remember, you're buying to open the one that is closest to the current share price, and you're selling to open the other one to basically reduce the cost. So this is saying a debit of 145. Let's click on trade and then think about this trade. So this debit is going to cost me $145. The width is 500. 500 minus 145 is 355. So the most money I can make on this trade is $355. If you wanted to do quantity 10 and risk that much money, that's on you. I'm only going to do one contract for you guys because I don't really like these, but we'll go ahead and execute. And there it is. We have a bear put spread in my account now. These are the contracts, the put that I bought and I sold. Now let's think about it, because the strike is 120 and my break even is 145 below that. So I need the share price of Starbucks to get below 118.55 before I start making money. So it's currently at 120, and over the next 2 weeks, I need to get to 118.55. And once again, I bought a debit spread, but if you think the share price of Starbucks is going down, why not just sell a credit spread where it's the other coin, and that way, if Starbucks trades sideways, you're still making money. So I wanted to load these in for you guys. We've now done a live example of all 4 kinds of vertical spreads. These are the tools available to you. Now, in the money, debit spreads are a little bit different, and I'm going to cover that in a future video. Okay guys, if you like these vertical spread tutorials and you want me to do more, let me know in a comment down below. Also give this video a thumbs up to support my channel. If you guys have any other comments, let me know. Till the next video, take care.